Are you planning to sell your home in Canada and wondering if you'll owe capital gains tax on that profit? Or maybe you're considering buying an investment property but aren't sure about the tax implications? Today, I'm breaking down everything you need to know about capital gains tax on real estate in Canada. And trust me, this could save you thousands of dollars or prevent a nasty surprise at tax time. Before we dive in, I want to be crystal clear that I'm not providing financial advice here. Every situation is unique and tax laws can be complex, so always consult with your accountant or tax professional before making any decisions. What I'm sharing today is educational information to help you understand the basics and ask the right questions. Let's start with the fundamentals. A capital gain is simply the profit you make when you sell an asset for more than what you paid for it. This applies to stocks, bonds, and yes, real estate, including your home. Now, you might be wondering, isn't that the same as equity? Not quite. Equity is the portion of your home that you actually own, which grows as your property value increases and as you pay down your mortgage. But a capital gain only happens when you actually sell and realize that profit. Here's how the math works in Canada. First, you need to calculate your adjusted cost base, or ACB. This isn't just what you paid for the property. Your ACB includes the purchase price plus all the costs associated with buying it, like legal fees, real estate commissions, land transfer taxes, and even major improvements you made over the years. So if you bought a home for $500,000, paid $10,000 in commissions and $1,000 in legal fees, your ACB would be $511,000. Now, here's where it gets interesting and where most people get confused. In Canada, only 50% of your capital gain is actually taxable. So if you made a $300,000 profit, only $150,000 gets added to your taxable income for that year. But here's the big question everyone asks me: when do you actually have to pay this tax? The answer depends entirely on what type of property you're selling. If you're selling your primary residence where you lived for the majority of each year you owned it, congratulations. You typically won't pay any capital gains tax at all. This is thanks to something called the principal residence exemption, and it's one of the best tax benefits available to Canadian homeowners. However, you will owe capital gains tax in several specific situations. First, if you're selling an investment property or rental property, you'll pay tax on 50% of any profit. Second, if you're selling a cottage, vacation home, or any secondary residence, the same rule applies. Third, and this catches a lot of people off guard, if you rented out part of your primary home through Airbnb or to tenants, you'll owe capital gains tax on the portion that was used for rental income when you sell. If you're finding this information valuable and it's helping you understand your situation better, I'd really appreciate it if you could hit that like button right now. It helps more people discover this content who might need it. And if you haven't already, make sure to subscribe to the channel and ring that notification bell so you never miss important updates like this. Also, if you know someone who's thinking about buying or selling real estate and could benefit from understanding these tax implications, please share this video with them. Your support truly helps me continue creating content that can make a real difference in people's financial lives. Let me give you some real-world examples to make this crystal clear. Sarah bought a cottage in Muskoka for $200,000 5 years ago. She just sold it for $600,000. Her capital gain is $400,000. But remember, only 50% is taxable, so $200,000 gets added to her income for tax purposes. Now, let's say Mike bought his primary residence in Toronto for $400,000 and just sold it for $900,000 after living there for 8 years. Since it was his principal residence the entire time, he owes zero capital gains tax on that $500,000 profit. But here's where it gets tricky. Lisa bought a house for $500,000, lived in it for 3 years, then rented it out for 2 years before selling for $800,000. For the 3 years, it was her principal residence. No tax on that portion of the gain. But for the 2 years it was a rental, she'll owe capital gains tax on the proportional amount of the profit. The Airbnb situation is particularly relevant right now. If you've been renting out your basement or a room in your home, you need to separate the gain between the personal use portion and the rental portion when you sell. This requires careful calculation and documentation, which is why professional advice is so crucial. Speaking of professional advice, if you're navigating any of these situations or thinking about buying or selling real estate in the Greater Toronto area, I'd love to help. I'm not just a realtor, I'm also a licensed mortgage broker, which means I can assist with everything from finding the perfect property to securing financing or restructuring your existing mortgage. I offer free consultation calls where we can dive deep into your specific situation, do an in-depth analysis of potential purchases beyond just home evaluation, and create a strategy that works for your goals. You can book a call directly through my Calendly link in the description below. Let's talk about all things real estate and make sure you're making informed decisions. Before we wrap up, there are a few more important points to consider. First, even if you don't owe capital gains tax on your principal residence sale, you may still need to report it on your tax return. The rules can vary, so check with your accountant. Second, if you have a capital loss on an investment or secondary property, you can use that loss to offset capital gains from other assets, but you cannot use a loss on your principal residence to offset other income. Third, the Canada Revenue Agency sometimes classifies frequent property flipping as business income rather than capital gains, which would be taxed at your full marginal rate instead of the 50% inclusion rate. Timing can also be crucial. If you're selling multiple properties or have other significant income in the same year, the additional taxable capital gains could push you into a higher tax bracket. Strategic planning with your accountant might help you spread out sales or implement other tax planning strategies. The bottom line is this: understanding capital gains tax can save you thousands of dollars and prevent major surprises. Whether you're a first-time seller or an experienced investor, these rules affect your bottom line and your future financial planning. Remember, this is educational content, and every situation is different, so always consult with your accountant before making decisions. If this video helped clarify things for you, don't forget that consultation call I mentioned. The link is right in the description, and we can discuss your specific situation in detail. Stay savvy, stay informed, stay knowledgeable, and until next time, may your investments flourish and your dreams of home ownership become a reality. Catch you in the next one.